Hello, guys. You're welcome once again to Forex Trading Made Easy. My name is Chinedu Anuoha, and today we are going to be looking at some chart patterns. So, remember, in a previous course, we talked about candlestick patterns, but in this course, we are going to be looking at chart patterns. Now, these are certain shapes that happen in the charts that show us where price is most likely headed. Okay, one of the major chart patterns is the head and the shoulders. Okay, price forms a head. This is a very popular chart pattern. Has a head. This is the head and two shoulders. Usually, some of the shoulders may not be equal. In some cases, some you may have a perfect textbook like head and shoulders. Now, what this depicts is a possible trend reversal or possible trend continuation, depending on where you find it. Okay, so this is called the neck, and how this plays out is price forms these two necks and one shoulder, one neck and two shoulders, and when price breaks this level, we expect price to most times retest it and continue going downstairs. So that's what we refer to as head and shoulders. I'm going to show you an example in the next slide. Rectangles. This is to depict a possible trend continuation. So price is falling and then all of a sudden starts ranging, starts moving within a particular range and then breaks, continues downwards. So these are called rectangles and these are called channels. Now channels work both for uptrend and downtrend. Now prices could be in an uptrend and then form something that looks like a mini trend before breaking to continue in the upward direction or in the downward direction as the case may be. Now, a lot of people argue that channels and flags are the same thing, but they are not. Channels are in this format like the flags, but the flags have small trends, smaller zigzag movements. Okay, so that's the difference. This has a smaller, it looks like a flag basically, but this one, the channels are bigger. Okay, flags are smaller and they depict possible trend continuation. It can happen both for uptrend and for downtrend. And then you have the pennants and the triangles. We'll talk about triangles. They are almost like the same thing but a little different. Okay, so when you see these shapes in the market, you assume that price is going in to break out in a particular direction. So this looks like a triangular flag, and then you have the triangles, which, like I said, looks like the pennants. Okay, these are descending triangles. Okay, we have descending flags as well. So these are, when you find this shape, there is a big possibility that price may want to break to the upside. Now, there are some popular trading patterns like the double tops. So you see two tops. This also looks like support levels. Price is most likely, when they break the neck, most likely to retest the neck and continue going downstairs. And the double bottom. So we have double tops and double bottoms, support, having this kind of shape. Some people call it the M's and the W's, but some call it double tops and double bottoms. So other traders may call it M's. Look at the M shape. So when you see these shapes, this is the neckline. This is also referred to as the neckline, and price can break above it. And usually when a break happens, it tends to bounce off the neck to continue. And then like the double tops, you have the double bottom, triple tops and triple bottoms. This bounces off two times, while this is three times before breaking. And this is three times as well. One, two, three before breaking to the upside. Okay, so let's look at, this is a typical price example of head and shoulders. So you see price going up here, forming one shoulder, going up there, coming down to a neckline. So this is almost like a perfect head and shoulder. You may not find it as a perfect, some may be slanty, but you get what the pattern looks like. So usually many traders may want to enter once this is broken, this level is broken. They want to consider this and go down. And like I said before, you must not trade a strategy based on just the entries and the exits that you define from one particular entry. There has to be a confluence of factors which we will discuss in a later course. Okay, so this is a flag. For example, in an uptrend, you find a pattern like this. Price has the tendency to break above the flag, and this is for a downtrend. Okay, this is a bull flag, this is a bear flag. Price has a tendency to break downwards. Okay, in an uptrend, this is a pennant. Some people argue that pennants and triangles are the same thing. You see an uptrend bullish, price breaks above pennants, bearish pennants, and you see price continuing down like that. Okay, so in the next course, we are going to look at a particular tool called the Fibonacci, and the reason why the Fibonacci is used as a technical tool for trading the forex market. If you have any questions, I want to hear them in the comments section. And if there are no questions, make sure you click the link at the description of this video to join and get our free Telegram signals and other information and fun stuff from Copyvest Academy. See you on the other side. Bye for now.